Hey everyone, welcome back to another lesson from Lesson Up Squad, and today we'll be doing financial ratios. So today you'll be learning why are financial ratios important, financial ratio hacks, some ratios which are specific and which you should be able to recognize by the name, the differences between operational risk and return ratios, and how to comment on ratios. Okay, so why are financial ratios so important? So, in a nutshell, financial ratios are like benchmarks, right? So, just like in school, you would have a certain percentage to be able to pass a subject. Financial ratios are indication of a business to be able to pass, to be able to, for the shareholders to look at it as a profitable business, right? So a business needs to assess whether they have been successful or not, and therefore they would use a ratio to be able to determine that. Now, once again, different users of the financial statements have different type of ratios that they require. A bank would look at your liquidity, shareholders would look at your profitability. So there's a lot of questions that can be answered through ratios. So ratios are very important and also very, very practical. In the real world, ratios are used all the time to prove if the businesses are doing well or not. Also, what I like about ratios is that ratios are quick things that you can do to determine how the business is doing. So even before you read the entire financial statements of a company, if you just calculate a few ratios of that business, you'd be able to ascertain how well or not well is the business doing. Okay, so I like to divide ratios into two parts. Ratios that are uncalled for, you don't expect it in the exams, and ratios that are your usual ratios that you're expected to know. So one of the things about certain financial ratio is in the exam they can ask you to calculate a ratio you've never calculated. But usually if they do that, they would tell you something like calculating gross profit percentage on sales, or sometimes it might even be advertising expenses on sales. How do you calculate something like this when you've never had to do it? And that's the first category of ratio. And the second category is ratios which are, for example, called asset test ratios or stock turnover rate ratios. And that by its name doesn't usually tell you what you have to do. But these kinds of ratio, which actually tell you what to do, such as gross profit percentage on sales, gross profit percentage on cost of sales, operating profit percentage on sales. Like I said, in the exam, you could be asked to calculate advertising expenses over sales or over all the total cost. How do you go about doing those kind of ratios? So it's very simple. In the question itself, your answer is available. So if you look at, for example, gross profit on sale, got gross profit percentage on sale, and here we're also doing that example. So say, for example, your gross profit is 70 and your sale is 100. Now, gross profit on sale is literally what the question is telling you. You take your gross profit and you divide it by your sales. So gross profit on your sales. So 70 divided by 100 gives you 70%. Should they require your answer to be in a ratio format? It doesn't matter. You can say gross profit to sales. This is how I like to write it down. And then I would put down what the values are. So gross profit is 70, sale is 100. I look at my smallest number, which is 70, and divide that by both the sides. So 70 divided by 70 would give me 100 divided by 70 would give me 1.42. So this actually ratio means for every 1 rand of profit you've earned, you've had to make a sale of 1 rand 42. That is what every single ratio actually means. It boils down to the same thing. What are you comparing it to? So in this case, we're comparing gross profit to sale. And here you can see your gross profit, for every 1 rand of gross profit, you get 1 rand 42. You need to have 1 rand 42 rand worth of sales. Also, another common thing in these ratios is a lot of the ratios will talk about turnover. Turnover is sales, so don't forget that. Okay, the second type of ratios are ratios that are specific. So these type of ratios, when I mean they're specific, they have a name. In the exam, you could be asked to calculate a current ratio or a solvency ratio, and you're supposed to know what these means in order to be able to calculate. So unlike our previous slides where it said gross profit on sales. If you didn't know the formula, it's fine because it's gross profit on sales. The question itself would guide you. But in these type of financial ratios, the question doesn't necessarily guide you. So you need to know that. But once again, it's not difficult. If you understand these ratios, you would be able to recall and remember them. So these type of ratios are divided into three: your operational ratio, your risk ratio, and your return ratio. Operational ratio tells you more about the operating efficiency of the business. So in the exam, if you're asked to answer or comment regarding the operating efficiency of the business, these are the type of ratio you should be using. Risk ratios are ratios which tell you how risky the business is in order to give a loan or in order to invest. Return ratios are more for your shareholders. So your shareholders would like to know how much would they gain should they invest in the business, and therefore those are your return ratios. Okay, so I just want to quickly go over explaining operational ratios on the slide. So operational ratio, the first one we have is current ratio. Current ratio by its name is telling you it needs to be current. Your current assets and your current liabilities. There's nothing else that is called current on your income statement or balance sheet. So it has to be your current assets versus your current liabilities. And that's what you would compare. Your asset test ratio is very similar to your current ratio, except in the asset test ratio, when you are using current assets, you exclude your inventory. The reason your inventory is being excluded is many people argue that your inventory is not easily convertible to cash, unlike your other current assets such as bank. You can quickly go to the bank and have your cash ready. But your inventory, although it is a current asset and you can turn it around in the next 12 months and therefore it is current, but it is not necessarily convertible immediately. Your inventory might take a longer time to sell, and therefore sometimes you want to know what your value of your current asset is, excluding your inventory. And once again, we compare it to your current liabilities. That's because it is believed that your current assets are supposed to pay off your current liabilities, at least the short-term portion. So whatever you have as current assets should be able to be converted to pay your current liabilities. The ideal ratio usually is 1:1. Stock turnover rate. So this ratio will actually tell you how fast your stock is being selling, how fast you are converting your stock into sales. Now, to convert your stock into sales, you would use your cost of sales. That's because that's the inventory portion. Your sale doesn't tell you your inventory. Your cost of sale would tell you your inventory over your average inventory. To calculate average, you'd always say opening balance plus closing balance and divide that by 2, or multiply that by half to get your average inventory. Your stock holding period. So every time you're calculating a ratio that is a period, right? So that is the number of days you want to know. You'd have to convert that ratio into the number of days. And to convert it to a number of days, you've got to multiply it by 365. So in this case, your stock holding period, how long are you holding stock? So what do? You've got your stock value, your average stock, divide that by your cost of sale, multiplied by 365, because that will tell you how quickly did you sell stock. Whatever stock you didn't sell is still your inventory, and that will tell you how many days you're holding your stock in. Usually people don't like to hold stock for a very long time because it's bad for the business. It's capital that has been tied up. Debtors collection period. So very similar to the one we just did, which is our stock holding period. Debtors collection period, you would use your average debtors, which is your opening balance and your closing balance, divided by 2 over your credit sale times 365. Because we want to know the period, the number of days, we have to convert it to days, and therefore have to use 365. Very similar for creditors. Our solvency ratio. The solvency ratio is your total assets is to total liabilities. From these ratios, you can see there's very few that you will actually have to learn off by heart and have to make sure that you memorize them. The others, you can actually, if you understand them, you wouldn't have to learn them off by heart. You'd be able to carry yourself through with the ratio. We then also have the risk ratios and the return ratios, which I'll discuss in the slides further. Okay, let's look at the risk ratio now. So remember our previous slide where we said our current ratios are your current assets is to current liability. because the expectation is that your current assets should pay your current liability. Therefore, in your risk ratios, you would actually look at your non-current liabilities to your equity. Your risk ratio is your debt ratio to your equity ratio. Usually the benchmark for that is 1:1 is a healthy. So what that is saying, what this ratio is trying to tell you is that for every 1 rand of liability, you can have 1 rand of equity. If you've got more liabilities, it is very hazardous to the business because they have to pay those payments to the bank, account for the interest, which can decrease profit. Also, the non-current liabilities would show, this ratio would specifically show the bank if as a business you can afford more loans. So say for example your ratio is 2:1. I mean, you've got 2 rand of liability for every 1 rand of equity. The bank is unlikely to give you a loan because you've already had too much of debt. So it shows the degree of risk the business has placed itself in. Look, in the practical world, there are a lot of time where the businesses obviously exceed these ratios, but they have a reason behind it, and also the equity is very strong in that case. And they would also explain to the shareholders why they have taken a loan. They're also able to substantiate the bank with other assets. So for example, a company that has already a lot of loan wants another loan from the bank, they would either give the bank a security, say a form of land or something in exchange to ensure that they will be able to comply in paying with these liabilities. However, for school purposes, you just need to know that 1:1 is a healthy ratio, and debt and equity ratio is calculating for how much of debt, how much of equity do you have. So the next ratio we're doing are the return ratios. Return on capital employed. So anything that is called a return is basically what you're giving back to the shareholder in turn for investing into the business. Returns are basically just your net profit. In this case, return on capital employed, this is a very good source of indication as to should you be getting a loan or should you be actually issuing more shares. So every time you have a question regarding should you be issuing more shares or should you take a loan out, this is the ratio you need to use, and I'll explain this why just in a few minutes. So here you've got your net profit before tax, which is your return, and you add your interest back. The reason you're adding your interest back is because you compare this ratio to the interest. So you can't take interest into account if you want to compare it to the interest itself. Divided by the average capital that you've employed times 100. So what is capital that you've employed? So capital that is employed is basically money that is being able to use to run your business, which is money from your shareholders and your non-current liabilities, so loan taken from the bank that helps you to run your business. And that is why those are called your capital employment. The only difference is shareholders' equity is people that invest in your business in exchange for dividends or profits, whereas a loan is banks that invest in your business in exchange to make sure that you pay the full money back to them and interest, which is their profit. And to calculate this, you would use average once again, your beginning plus your end, and you divide it by 2 or multiply it by half. This is very, very important ratio. Like I said, once again, if you have a question to answer about buying shares or issuing shares or getting a new loan, this is one of the most important ratios to use because it really shows you the profit you have made and how much you've invested in your business. This ratio will also indicate whether the business has a return on capital employed that is higher or lower than the interest paid on loan. So say for example, you have an interest on loan that's 26%. That's a cost, 26%. And your return on equity is 17%. So in this case, you should be able to sell more shares so that because you've got a lot of cost already on your income statement, your interest on loan is extremely high than your return that you're getting. Therefore, issue more shares so that your return can increase, whereas your interest on loan won't increase. Also, if you need, say for example, your interest on loan is 13%, but your return on capital employed is 20%, that means you're already getting a benefit of 20% and your cost is only 13%. Therefore, you can still take some more loan to be able to run your business efficiently. Okay, so the next ratio we're looking at is return on shareholders' equity. This ratio will also tell you, guides you what to be using. So you've got your return on shareholders' equity. So that would be your net profit after tax, and you divide that by your shareholders' equity and you multiply it by 100. Once again, average is your beginning plus your end divided by 2 or multiplied by half. So what this ratio is showing is what are shareholders earning for every rand they're investing. So just the shareholders, this time it doesn't involve liabilities or bank, it's just return on shareholders' equity. So for the amount of equity the shareholders have given, what is the return in proportion to what they've given? And that is a good ratio to determine for the shareholders on the AGM, which is the annual general meeting, that what net profit must be now paid out in the form of dividend, right? So what happens is you've got your net profit after tax, say your net profit after tax, and you divide that by your shareholders' equity. That gives you a decimal number, which you would then convert to a percentage to understand what you've got as a return on that. What usually happens in these type of question is they might tell you that your investment, if you invest money in another company, you will earn 20%. Now say using this formula you calculate 12%. So what is more beneficial for you? It means it's more beneficial for you to be able to just invest your money in the other company because you're going to earn a bigger return. Here you've only earned 12%. But in the other company, you would earn a return of 20%. And that means that you can actually use this ratio to be able to compare where a shareholder should be investing, because it's a return on what they are investing, their shareholders' equity. Another ratio to use for return is your EPS, which is your earnings per share. So your earnings per share is your net profit after tax, because you can only pay your shareholders after you've paid your tax, divided by the number of shares that you've issued, multiplied by 100 to be able to give you 100 cents per share, right? Now, just so that you guys can understand, in the next slide we'll be doing dividends per share. So earnings per share is the maximum amount of earning that you can actually pay a shareholder. So it's absolutely rare that a business will pay out an earnings per share. If not, very, very unlikely. I've never in my entire career seen somebody paying out the entire earning per share. So the earnings per share is basically what shareholders have earned. It doesn't mean it's the money they're getting, because the money that they're getting, you can't actually pay your shareholders everything they've earned, because then you would have no money in retained earning to be able to expand your business or to function your business. So earning per share is just an indication of how much they are earning, and that will affect your market value of the share prices on the securities exchange, such as the JSE and stuff. So that will help the investors to know how much they can sell the share for. But once again, it is not the money that the shareholder will actually receive per share. Which brings us to our next return ratio, which is your dividend per share. So now dividend per share is your total dividend for the year. That includes your interim dividend and your final dividend divided by the number of shares that you've issued, multiplied by 100 to give you cents per share. Right? The 100 will ensure that you're actually converting it to rand. So 1 rand equals to 100 cents, and that's why you've got cents per share. This indicates that the portion of the total earning of the company that the shareholder receives. So now, unlike your earnings per share is a maximum. Say you've earned 2 rand per share. What your company paid out is 1 rand per share. So that means they've retained the 1 rand per share, and that becomes part of your retained earning, which is used for your future expansion of the business, to pay out a loan, to purchase another company, to increase operating efficiency in the company. So there's various reasons why there's retained earning. It's very important to have retained earnings to be able to survive the business. But dividends per share is the actual money you get paid. So I hope this makes it clear when to use earnings per share and when to use dividends per share. So earnings per share is more to assess your market value of what the share price is, but dividend per share is how much do I actually get paid in the short term. Okay, another ratio we'll look at is the net asset value ratio. I know a lot of people get confused with the formulas. That is why I'm trying to teach you how to remember the formulas. So in this case, your net asset value. What is your net asset value? Net asset actually means your assets minus your liability. Now, if you recall your balance sheet, your assets minus your liability actually equals to your equity, which is also your accounting equation. So therefore, your net asset value is just your assets minus your liabilities, which is your equity, over the number of shares that you've issued, multiplied by 100 to give you the cents per share. So your net asset value tells you the actual value of the shares according to the financial statement of the company. So it tells you what your asset, what is the value of your equity that is actually per share. And this is something that can also influence the market price on the JSE. This is usually used if the question says you need to determine if it's favorable to get a business, or how do you know if this business is doing well? Do they have a lot of assets? So in these type of questions, you'd look at, well, if I want to buy this company, are they really valuable? What is the asset value? What is the net asset value? We look at net assets because say you have assets and you've got liabilities. You want to know what is left after paying up all your liabilities, because liabilities are debt. So if you've got 100 Rand asset and you've got 100 Rand liabilities, it's probably not worth investing in that company because it has nothing for you to be able to get a return out of. All the assets will pay their liabilities and you get nothing. But say, for example, the assets are 100 Rand, liabilities are 60 Rand, you've got 40 Rand worth of owner's equity or ordinary shareholders' equity that is extra, that is in excess and is retained earnings. And therefore, that will influence the market price of the share. Okay, so before we look at a question, I just want to give you some tips on how to approach a financial ratio question. So firstly, determine if it's an operational, risk, or return ratio that you need to use. Once you understand which ratios need to be used, you'll be able to put down the right formula and think about the right ratios in the right direction. The next thing you do is always compare your ratios. You can compare them to last year, you can compare them to a benchmark, or you can even compare them to another option. Say, for example, you're taking a loan or you're doing your ratio for return on total capital employed. You know you must compare that to your interest on loan. So make sure that you are comparing it to something. After you've compared your ratio, also indicate how that happened. So say, for example, you did a gross profit percentage ratio and your gross profit percentage from last year increases this year. How did that happen? Yes, you've calculated your ratio. You've said that you've compared it to last year and you said it was higher than last year, but also tell us how and why is it higher from last year. So say, for example, say inventory was purchased from a cheaper supplier and therefore the cost of sales is less this year. These type of things will help you gain a lot of your marks. Also explain the user what the ratio means. So say, for example, you're calculating your current assets to your current liabilities. So say that you want, in this ratio, you're trying to ascertain if your current liabilities will be paid off by all the current assets that you have. And you determine it. Once again, you would say, okay, this is what the ratio does. And now that you've calculated the ratio, it has improved from last year. Why has it improved from last year? Because we bought more assets. So if you put down all these points, you should be able to earn your full score on financial ratios. Okay, let's look at a question now. So I've used an example from 2014 Exemplar. I'm using an example from this past paper. It's quite a bit of an old past paper, but I'd like to use that example because I know many of you would only go through your recent ones. There's a few things I've highlighted. Doesn't mean that other things are not important, but I just wanted to highlight a few things, such as the interest rate always given on your balance sheet. That's a good indication for you that you will need to compare to someone. Same for the loan over here. Also, just current assets, current liabilities. This is what shareholders' equity is. It's made up of these two elements. I've also highlighted interest expense, before tax net profit, after tax net profit, your interim dividends, and your final dividends. Now, just that net profit before tax and after tax, there are certain cases where you use the one before tax and after tax. So just make sure that you know when to use what. Okay, so this is a very easy start to a question, because in this question, unlike other questions, you didn't have to determine what ratios you have to calculate. It tells you have to calculate your asset test ratio, your percentage on average shareholders equity, your equity ratio, and your percentage return on average capital employed. And here they even tell you to use your net income before tax. So I'm not going to go into much detail with this, because this is applying the formula we've just gone through. Your asset test ratio will be the same as your current assets minus your inventory. What do you compare to your current liabilities? It's so important to see and put these into your ratio format, because you would actually get a mark and you would be penalized if you're trying to do it in a percentage format. So make sure that you do a ratio always in the terms of in a ratio, and you'd know this by the name of, once again, of the question, or the ratio they're asking you to calculate. See, here they told you to calculate asset test ratio, so it is going to be in a ratio format. Here, debt equity ratio, it will be in the debt equity ratio format. The calculation of your percentage return on your average shareholders equity, so that's basically your return, which is your profit, over your shareholders equity, just your shareholders equity. And remember, it's average, so you can just multiply it by half and multiply it by 100 to get a percentage format. Debt equity ratio is the same thing. Your non-current liabilities to your equity, remember, it's non-current because your asset test ratio, or your current ratio, will determine your current assets to current liabilities. You want to know with your long-term loans in this ratio. Even this one, 5.3.4, calculation of percentage return on average capital employed. So that's your return. In this case, they told you to use your net income before tax. So you have to use your net income before tax, and you would have the average of your loan and your equity to be able to give you your average. So remember, this is your opening balance plus your closing balance of both your loan and your equity, and that should be able to give you half. So what I like doing, just like in this question, I would just add up for 1 year my loan and equity on this side, my loan and equity on for the beginning of the year and for the end of the year, and I would multiply it by half to get an average. That is the easiest way to calculate it. You can always do the calculation in more steps if you're comfortable, so there isn't a limit of the number of steps you can follow in accounting. You can go as many steps as you like. Just make sure that the person who's marking your paper can understand what you're doing, so even if you lose a mark somewhere along the line, you're able to get marks for your steps. Okay, so I want to look at this question specifically because it's a theory question, and it says the directors are pleased that the operating efficiency of the business has improved. Quote and explain 2 financial indicators to support their opinion. So the one good thing about this question is they're telling you that the financial directors are happy. You may have a question which tells you to determine should the financial directors be happy, and in that case it will also apply the same thing. You must just make sure that you actually calculate your answer and you can justify your answer why they should be happy or why they shouldn't be happy. Also, when we're dealing with the operating efficiency of the business, operating efficiency of the business talks to your income statement. If you would like to know if your business is operating efficiently, the operations of your business is operating efficiently, you would look at your income statement. So you would look at ratios such as your operating profit on sales, operating expenses on sales, operating margins, and they're telling you that it has improved from last year. Therefore, that means you need to compare it to this year to be able to prove that yes, what they are saying is correct, and these are the type of ratios you would actually use to determine why they should be happy and why you should indicate why you should support their opinion. Okay, if you look at this question, it says, according to the Companies Act, the directors may repurchase shares only if the liquidity of the business is acceptable. So in this question, they actually told you that this is one of the conditions of the Companies Act. But I want you to remember this today, that this is one of the requirements of the Companies Act, that should you want to repurchase shares, your liquidity position of the business needs to be acceptable. You cannot repurchase shares, but you do not have funds, and it's going to cause more harm to the business. So this is something you can actually use to answer another question in the exam, that it is a requirement of the Companies Act. Okay. Also, when we're dealing with liquidity of the business, liquidity talks to your balance sheet. You can't determine liquidity looking at your income statement, so you would only use ratios that are on your balance sheet. Now, to determine liquidity of the business, right, the things you would look at would be your current assets to your current liability, because you want to see liquidity. Liquidity means how liquid your business is, how fast your business can pay money, and how much money does it have. So you would look at your current ratios. You can also look at your asset test ratios. You can also look at your bank balance ratios, which will tell you how much money do you actually have. And all three of these are an indication of your liquidity and how liquid your business is. Okay. If you look at this question, the directors want to establish another branch in a different area next year. They will need a finance of 1.5 million to do this. One of the directors has suggested that they finance the expansion by increasing loans instead of issuing new shares. Quote and explain two financial indicators to support his opinion. So that means, once again, in this question, we don't need to determine his opinion. We've been given his opinion. We now have to substantiate his opinion, which is that he wants to increase loan. We know for that we should be using the return on total capital employed and comparing it to your interest loan. So therefore, your interest loan will be less than your return on total capital employed for you to be able to rather take more loan than to actually issue new shares. So also in these type of questions, you need to ask the question, how much debt or equity does the business have? What is the cost of the loan? Why is it better to issue shares or a loan? But in this case, they would like us to support a loan. So why is it better to take a loan? Because the interest on the loan is less than the interest of the return on total capital employed. And that makes it better for us to take a loan, because the cost of the loan is less, whereas our return is too little on the equity. So you'd rather get a loan and not issue more shares. Also, the question further tells us to explain two other factors with advice that the director should consider before embarking on this expansion. So these are what we call qualitative factors. So these have nothing to do with numbers, but these are other factors that would influence a business decision. So remember, they're want to open up a new branch in a new area next year. So firstly, you should be able to see that it's a new area. So is there a demand in that area for a product? How would we know if there's a demand? We'd need to do some market research. Do we have resources, employees to be able to work in the new branch? We should be able to train our staff. If we don't have enough staff, we should be able to train some new staff to be able to work there. So these are known as qualitative factors, and these are things that you should just take a step back in the exam and think about it as if it were your business, and the ideas would come quicker and sooner to you. Okay, so that brings us to the end of today's lesson. So we learned some important things about ratio as to how to calculate certain ratios, how to identify what you're supposed to be using for calculation, whether they're operational, risk, or return ratios, what they mean, and how to comment on these ratios. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.